Whether you're new to crypto or you've been here for years like myself, the goal is always to build a profitable portfolio. Now, in stocks, you could just invest in the top 100, 500, or even the entire market for whatever market you are targeting. But would this strategy actually work in crypto too? Stick around and let's talk about it. Hey guys, I'm Sprague, and the foundation for the portfolio that I still use to this day was built back in 2017, which consisted of Bitcoin, Ethereum, Stellar, and Monero. And while, okay, I don't still hold all four of these, and over the years my allocations have changed into each of them, it was the portfolio that really got me hooked on investing in crypto. But now that I can use the power of hindsight, should I have actually started with a different set of coins? Now, I don't usually put this disclaimer in my videos because I try and stay on the research and education side of crypto only, but given the topic of this video, I do think this needs to be said. I am not a financial advisor, and nothing in this video should be taken as anything other than just purely educational content. All I'm doing is trying to show you what backtesting specific portfolios would have resulted in. I'm not trying to give you advice on how to build your portfolio. So since the sentiment seems to be so wildly shifting between whether or not this is a new crypto winter or just a dip in the market, I'm going to use January 1st, 2018 as the start date for all of the portfolios that we're going to be simulating. This is because it's near enough the peak of the last market cycle, and when prices are high, it attracts the most attention and therefore the most new money. And our goal is to try and create a portfolio that not only is profitable, but also has some resilience against the bear market that would follow. So if after entering the market, you DCA'd $100 into Bitcoin every single month, you would end up with a portfolio of 24 grand, with a respectable 19 grand worth of profit, which is pretty good. Not retirement money, but it's pretty good nonetheless. The same DCA into the, at the time, far riskier investment of Ethereum would result in a profit of 55k. However, and I'll get into proving this later in the video, just because Ethereum was sitting at the number 2 spot for market cap at the time doesn't mean a huge amount. So let's go bang in the middle and put 50% of our allocation into BTC and 50% of our allocation into Ethereum. We're basically saying that half is going into the tried and true store of value that is Bitcoin, and half is going into the speculation that DeFi and decentralized computing are going to become big things in the following years with Ethereum. Using this, we get our baseline portfolio to beat, which is a $41,000 value portfolio with $37,000 of profit. This is also a great example because this portfolio was profitable more months than it wasn't, at 62%. Now, before we get into the other backtests, I did spend the last week building this website just so that I could backtest the strategies for this video. So if you enjoy it, please leave me a like and a comment down below to let me know it was worth it. And if you want to see more like this, hit the subscribe button. Now, I'm not sure whether or not I'll be able to get the website finished before this video goes live. However, at some point I will update the description to put a link down there so that you can go and backtest your own strategies if you want. The logical place to start would be to try backtesting one of the most popular index funds, the S&P 500. In this strategy, we're going to take our $100 monthly and split it across the top 500 coins. If a coin drops out of the 500, we'll sell it off, take the funds that we gained from selling it, and reallocate that back into the top 500. Now, running this portfolio, we only come out with 14 grand profit, far less than the 37 grand that our baseline portfolio managed to make. This does, however, make absolute sense. Unlike in the traditional stock market, anyone can create a coin and have it listed. This means the top 500 could at any time have a bunch of one-shot coins in there that are just going to make it in there 1 month and then die out the next. And in fact, the top 500 coins by market cap has been held by 1,400 different coins over the last 3 years. So maybe we need to account for this volatility in the crypto market and change our top 500 to instead be top 100. Running this portfolio, we end up with a profit of 18 grand, which isn't even as good as just DCAing into Bitcoin, let alone our BTC ETH portfolio that we built. And again, even in the top 100, over 300 coins have held spots there. So maybe we need to take this even narrower and just look at the top 5. Now, given that we know that a BTC and ETH portfolio will bring us 37 grand worth of profit, we are really only looking at market cap positions 3, 4, and 5 with this ETF. So just for fun, let me know down in the comments how many coins you think have been in positions 3, 4, and 5. Now, it probably isn't going to surprise you that this portfolio underperforms our BTC ETH portfolio by 15 grand, which is pretty insane when you consider that 2/5 of this portfolio is our baseline portfolio. And just for anyone that did comment down below, 12 different coins have been in positions 3, 4, or 5 over the last 3 years. It's pretty clear that investing in the entire market or a portion of the entire market as a whole is definitely not the answer for profit, but could it be the answer for stability? One fundamental rule of building a strong portfolio is diversification, and for that reason our baseline portfolio of just Bitcoin and Ethereum is actually quite a risky one. Despite what news publications and people in the crypto scene seem to suggest, none of us can see the future, and therefore we don't know for guarantee that either of those two coins are actually going to survive the next 5 years, let alone continue to be profitable. So let's see what happens if we now remove Bitcoin and Ethereum from our top 100 ETF and just invest in the other 98. I will admit, this one actually did surprise me a little when I ran this backtest, because it's only $900 less profit than if you'd included Bitcoin and Ethereum, which are widely regarded as the two top contenders. There's a few potential answers to this, but the one that I think is the case is the fact the whole market moves with Bitcoin. Therefore, when Bitcoin goes up, so does everything else, and when Bitcoin goes down, so does everything else. The discrepancy comes from the fact that Ethereum at this point is actually capable of moving on its own, and could account for the reason why the profits are different. And later on in the video, you will actually see that Ethereum will outperform Bitcoin on most occasions. And we can actually confirm this by only excluding Bitcoin and running the same portfolio again. Well, now our top 100 minus Bitcoin actually almost matches the top 100 including Bitcoin. This is why index funds are widely regarded as being the way to grow long-term wealth. This is because it gives you the stability to know that if a single coin, or in the case of the crypto top 100, 200 coins, suddenly drop out and disappear, your portfolio is still going to look pretty much the same as it would if those coins hadn't dropped out. You're betting on the whole market and not just individual tokens or coins. Now, before we do a backtest into a quote-unquote real portfolio, let's just for fun see what would happen if any time a coin entered the top 100, we just put $10 in it and then held it. Now, I don't know if I'm actually going to be able to get a chance to build out the website UI for this page yet. I've only implemented the logic so far into the back end, so forgive me if what's on screen right now is just pure data. Now, this might be the worst performing legitimate back-tested portfolio that I have tried, bringing in only 7.5 grand on a 4 grand spend. Now, this is to be entirely expected. Due to the date that we are starting our portfolio on, we're buying a lot of the coins that are going to do very well this bull run at their previous all-time high. This means that coins like Nano, which haven't done too well this bull run, have lost us 9 out of our $10 investment. In fact, 127 of the coins that we invested in lost 90% of their value. And while there is inevitably going to be discrepancies in the data that comes from CoinGecko that I'm using to run these backtests, for example, at one point, trying to run an ETF over the top 500 coins was returning a profit of $32 million because it had a coin dropping to nearly a pico penny and then straight back up to 11 cents. But it's really not that hard to believe that there was a lot of rug pulls happen and a lot of coins that pumped once to get into the top 100 only to then immediately fall back out and fade into obscurity again. This might lead you to believe that this portfolio strategy has no grounding and is therefore worthless, but you'd actually be wrong, because by the time a coin has hit the top 100, it's actually got very little upward growth to go, aside from if the entire market moves up. So if instead we zoom out and we say we buy the top 500, well, now we end up with our most profitable portfolio coming in at $258,000 of profit. Due to the fact that market cap is calculated by price times the circulating supply, a lot of coins with a very low price can actually get into the top 500 market cap by just also having a low circulating supply. This is what allowed coins like Phantom, Matic, Kusama, Thorchain, and even Solana to make multiple $1,000 profits off of just a $10 investment. But, and this is where I pop the bubble for this portfolio strategy, unfortunately, doing this would be nearly impossible. A lot of the time when these coins are super low circulation or very low price, it's because they're running an ICO, which normally have a minimum spend, and therefore you wouldn't be able to just pick up $10 worth of that coin. And the problem is you don't know which of these coins is going to do well over the long term. So you might spend $10 getting one coin that makes $1,000 profit, but then spend $1,000 getting another coin that makes nothing and goes to zero. therefore eroding any profit you had. On top of this, a lot of the tokens are actually built on Ethereum, which then means that you have to pay hundreds of dollars worth of gas fees, again eroding into any profit that you would have made. Moreover, like a lot of the portfolios, this didn't turn a profit until December 2020. The difference is that while all of the other portfolio strategies that I've ran have only been down a few percent every month, this one was sitting at a consistent between 20 and 40% loss for pretty much the entire length of the portfolio. And an extremely large portion of the coins in this portfolio either rugged or lost liquidity entirely. And I'm not even going into the logistics of trying to hold and manage a 1700 coin portfolio. Okay, so we've established that spreading out our investment over a large range of coins is going to return somewhat less than focusing on just the two biggest ones, but does give us some shielding over coins coming and going as happens in crypto. This means that if anything was to happen to Bitcoin and Ethereum, our portfolio would in theory be completely safe. But could we take some of the most talked about and most hyped coins from 2018 and build profitable portfolios around them? So first, let's start by building an Ethereum competitor portfolio, because even back in 2018, people already thought that they'd missed the boat on Ethereum and were looking for the next best thing. So from what I can remember of that bull run and using articles that I found from 2008, the main competitors that I could find are Cardano, EOS, Neo, and Qtum. Now I know that technically Ethereum Classic could have made its way into this portfolio. It was very easy to find a lot of detractors for Ethereum Classic even back then. So this is why I've opted to leave it out of our hypothetical portfolio. Splitting our $100 monthly DCA over these four coins actually does result in a fairly nice profit of $18,000. But when we look into it a little bit, we find it's not quite as it seems. Pretty much all of this portfolio is just Cardano. So not exactly stable because we're relying on a single coin to do most of the heavy lifting. And on top of this portfolio was not profitable until the current bull run. So not exactly ideal. So next we'll build out a Bitcoin competitor portfolio, which consists of Ripple, Stellar, Litecoin, IOTA, and Dash. Now, if you're a fan of any of these coins, I would suggest looking away now because this one did not perform well, only bringing in $5,500 worth of profit. The thing is though, that none of these coins have performed particularly well this bull run, and that's pretty much what's given all of the other portfolios their value. On top of this, unfortunately, this is the portfolio that has done the worst when it comes to number of months in profit, with only 36% of the months between 2018 and now being spent profitable. Now, that isn't to say that you shouldn't have invested in these coins, because they have still made profit, and I will be including them in the portfolio I build at the end of the video, because they were very talked about back in 2018. But before we get into that, let's run a portfolio backtest on this article I found from 2018 called 6 Undervalued Cryptocurrencies That Have the Potential to 100x. This portfolio consists of Deep Brain Chain, Sun M, Oyster Pearl, My Wish, Nebulas, and Mercury Protocol. Or at least it would have done if Oyster Pearl hadn't been hacked 10 months after that article was written and immediately died because of it. So that's a very quick black mark for this portfolio. So splitting our DCA between the 5 remaining coins gives us a portfolio that is the worst performing in terms of number of months profitable, and also only returns 13k, with 11 grand of this being Sun M on its own. So not exactly the 100x that we were promised, but still actually not a horrendous overall result. Alright, so let's wrap this up by taking everything that I've covered in this video and turning it into a portfolio that could have actually seen us through from 2018 to now. Now, just to reiterate, this isn't about building the most profitable portfolio. We already have that with Bitcoin and Ethereum. And without using hindsight, there's really no way to do that to beat those two. Instead, we're trying to build a portfolio that is profitable, but also stable and risk averse. So unsurprisingly, we're going to start with BTC and Ethereum as the foundation for our portfolio, allocating 25% into each of those. And now we're going to pick our Ethereum competitors. This one's actually fairly difficult because back in 2018 there was a lot of coins challenging Ethereum, but none of them had actually delivered what Ethereum could do yet. Take Cardano for example. Cardano did release its testnet for smart contracts not long after our portfolio is being formed. However, it took until last year for them to actually implement smart contracts and therefore be a viable Ethereum competitor. And it's not just Cardano, this is actually a case with pretty much every single coin that came out in 2018 saying it was going to compete with Ethereum. They were all just marketing hype and talk at the time, and then only really a few of them went on to realize the goal that they set. So rather than try and pick the ones that actually were Ethereum competitors, we're going to go with the ones that were the most talked about, which is the 4 that I mentioned previously. However, we're actually also going to add another one with Stratus because it was extremely hyped back in 2018. We're going to put 4.5% into each of these, bringing it to a total of 22.5%, meaning that our portfolio right now has an allocation of 72.5%. So now that we've covered our hedges against Ethereum, we're now going to cover our hedges against Bitcoin, which again, we're just going to stick to the ones outlined above because they were the most common and talked about BTC killers. And again, we're going to go with 4.5% into each of these, leaving us now with 5% remaining to play with. Now, a lot of people at this point might consider this portfolio to be either too many coins or over diversified. Round up all those other allocations to 5% and call it a day. But leaving ourselves this 5%, we can put this into some random picks that don't necessarily fall into either of these two categories, but still could have the potential for upside. The first of these coins being the one that everyone loves to hate, Dogecoin. Even in 2018, Dogecoin had already proven that it had staying power, regularly sitting within the top 50 coins. On top of this, it was really the only meme coin anyone actually wanted, and was still spoken about fairly frequently, meaning that a small investment into this of just $2 every month is actually not a bad decision. And then using the remaining 2.5%, we're going to put it into Monero, because at the end of the day, crypto was founded to be anonymous currency, and that is what Monero does best. On top of this, Monero was extremely popular back in 2018, even though it has fallen out of favor somewhat now, given that the market has moved away from its origins and roots and ethos. It was still a strong pick back then, and it's still likely to continue being a strong pick far into the future. All of these coins are coins that could have made it into your portfolio in 2018 without using the power of hindsight, because they were all very talked about and had a lot of news coverage. And it's not unrealistic to assume that someone at some point probably actually did hold all of these coins in their portfolio. So with this portfolio, we end up with 34 grand, or a profit of 29k, which yes, is still 8 grand less than just our BTC Ethereum portfolio. However, if anything had happened to these top two, there'd been a shakeup, or anything had managed to dethrone either one of them, our portfolio would have actually been able to absorb that hit, unlike just investing in the top two. This is especially evidenced by the fact that on nearly half of all months, this portfolio was profitable. I'll put the stats on screen now for how each coin performed, but the outliers are obviously Ethereum making 13 grand worth of that profit on its own, followed by Doge and BTC, which both ended up about the same amount of profit. And at the bottom we have EOS and Dash, which actually EOS was the only coin to make a loss over this portfolio. So I hope you guys found this video informative. The point was not necessarily to tell you what you should or shouldn't have invested in, but more that you should spread your investment over a wide variety of coins so that you can have more stability and consistency. It's very easy to look back now and say, well, of course Cardano did well. It's a really promising platform. But at the time, there was many promising platforms, all of which have not done nearly as well as it has done now. Same with Doge. It's very easy to look back and go, well, of course Doge was going to pump this year because it's the best meme coin. But in reality, there's so many meme coins that you're taking a pot shot on any individual one. And it's basically just dependent on you being lucky. For this reason, spreading your risk over multiple coins means that you can absorb some of the risk by holding each individual one. Now, obviously, I am also constrained by the complexity of the platform that I created to backtest these strategies. I can't simulate whether or not you'd have sold off EOS when it pumped back in May and finally turned a profit for the first time in multiple years. And I also can't simulate whether or not you would actually keep up your DCAs through a bear market, or if you'd lose hope and end up stopping. But I think on the whole, this does show you that at the end of the day, yes, you will make the most money if you just invest in individual coins, but individual coins come and go. There was 1,400 coins in the top 500, there was 300 coins in the top 100, and there was 12 coins in the top 5 over a time span of just 3 years. That is an insane amount of churn. So I hope you guys enjoyed this video. If you did, leave me a like and a comment down below. And if you want to see more like this, please hit the subscribe button. Thanks for watching. Bye. Remaining 5% and put it into things that really get out of here. Really?